Welcome back to Morning Trade Live. It's time for the big picture. Let's welcome in Nathan Peterson, Director of Derivatives Analysis at Schwab Center for Financial Research. Very good morning to you, Nathan. What do you make of what we're seeing out there in the market today? I was just having a good chat with Peter Anderson, who isn't giving credence just to this US-China sort of re-escalation with China cracking down on ships. It's also a few questions out there, perhaps around the whole AI monetization story as well. Is that what you're seeing out there?
You know, I would kind of side with that. My weekly blog that I did last week, I was just really talking about, how we saw this outsized, down near 3% move in the S&P 500 on the Trump tweet, which was elicited by a lot of the restrictions that China had imposed. And look, I'll acknowledge, first, number one, in this trade relationship with the world, China is number one. It's the most important. But number two, it was the setup going into that announcement, because prior to that, the markets really didn't care about trade. They didn't care about new tariffs. We're not going to react. We're not going to bite unless we actually see it show up in the data. But it was enough of an excuse, I feel like, to get some of this liquidation from this froth, this excess that's been going on. We know that the SPEC Momo cohort has been working for a while. But Sam, we talked last week, so when I look at this price action here, we talked last week about the Philly Semiconductor Index and how I mentioned that the RSI went up to a 14-year high. It hit like 84, 85. And that we really couldn't tell at the index level what was going on underneath the surface, meaning all of the big movements we see from the non-profitable, low-quality tech, anything that has an announcement type of move. And so it looks like a little bit of that got rattled. You rattle the confidence of those Momo traders when you do something like Friday's price action. Secondly, if we respect this uptrend that we've seen in the S&P 500 since April, we have not had two consecutive day closes below the 20-day simple moving average. Yesterday is the first time we got number two. It looks like today we'll get number three. So why do I bring this up? Just from a near-term trading perspective, for those that are active out there participating in a lot of these big moves that we see every day, I think with the stocks at the index level, 14-year RSI, you get an orange flag. Now it looks like 3 days closed below the 20-day SMA, orange flag. You look at some of these announcements that are coming out, and they're coming out, daily or a couple times a week, whether it's AMD and Oracle, whether it's Broadcom and OpenAI, et cetera, but the punch, the reward for these types of announcements, A&D is up, $1.50 on this news here. When you start to see some deterioration where maybe you don't get that much of a positive response, maybe you don't reward the dip buyers as often or as frequently, these are some of the early signs which you could see a near-term shift in sentiment or trend. It doesn't necessarily mean down, but it means, hey, maybe you could be a little bit cautious, pull some exposure. We could be going through some chop here for the next couple of weeks.
Okay, so we had the earnings starting in earnest today with the big banks reporting. I mean, looking pretty good as far as what they've been saying, although we are seeing a bit of a mixed performance as far as the share price is concerned. I mean, everybody's been talking about how the earnings is going to be sort of the next catalyst now, obviously in the absence of the data, with the big question marks still around Fed policy and also the tariff question as well. What do you make of what we're seeing, hearing from the banks and the reaction in the market today?
I'd say so far so good. Sam, if you look historically, the financials, yes, very important economic barometer. The results look pretty good to me across the board in terms of being firm. The price action, it's not uncommon to see, financials sell off or have a mixed response or a muted response post earnings. So it's a bit early. Let's get into some more of the cyclicals, and then we'll get into mega cap tech here in a couple of weeks. And it's not just what mega cap tech and that high, adjacent type tech plays report, but it really is that price action. That will tell us whether we're priced in or not. I would say more importantly, near term, what I'm keeping my eye on is the bond market here. Sam, I think that we've got the conjunction of now we have a fundamental kind of a uncertainty that is building a little bit. Number one, around China-U.S. trade. Number two, around the government shutdown. And then number three, what I'd point to is the yields on the 10-year, which is getting ever so close to that 4% level. I think if we breach 4%, Normally, we think lower yields are better for the market, but if you look at what the IMF said today about potentially we haven't seen the effects of tariffs, then you look at China escalating the trade relationship with the U.S. today. So it's going in the wrong direction. If you get 10-year yields to breach that 4% level, I think that could bring in some more volatility and potentially we can get a bigger pullback here in a couple of weeks. So near term, that's what I've got my eyes on. Of course, earnings are important. They're going to give us a read-through in terms of where we stand on this rally, in terms of whether we're priced in. But if you look at the estimates, they look healthy. FactSet looking for 13% next year. We'll keep an eye on those estimates and see how they fluctuate as we begin to get more of that economic data that comes in.
Nate, fantastic overview. Really appreciate your insights today. And we have actually recouped that 600 level in the S&P 500 today. So we are off the session's lows. Thank you so much. Appreciate your time today. Nathan Peterson, Director of Derivatives Analysis, Schwab Center for Financial Research, joining us there.